Hey guys, welcome back. This is Fran. Last week we went over the term Roth IRA. So now you should know what a Roth IRA is, which is simply a type of retirement account. If you need more details regarding that, after you're done watching this video, I would strongly recommend that you refer to my last video regarding Roth IRA. Today we're going to be talking about a different term, and it's going to be emergency fund. Now, before I do so, I just want to make sure that I go over a few points with you. Number one is that before you start investing in the stock market, please make sure that you understand everything that you're investing in. And that's very important because you're actually investing your hard-earned money. The second point is to make sure that you do not invest more than you can afford to lose. Now, that does not mean necessarily that you will lose your money in the stock market, but investing in general, it's a risky thing. So if you are investing, you have to make sure that you do not invest more than you can afford to lose. The third point is that we all make mistakes, and you do not want to be in a situation where you lose your invested money. So it's important that you keep these three things in mind before you start investing. Now, regarding the emergency fund, an emergency fund is basically a savings account, a dedicated savings account that you should have to allow you to cover unexpected expenses. And emergencies are exactly that. They are unexpected, so you don't know when that's going to happen. You just want to make sure that you do not invest any money that you may need to cover any unexpected emergency. So if you create that account and you have that money saved up, if you were to invest money in a particular investment account, if there were any drop in the stock market, then you would not need that money. So you can leave that money untouched so that it can continue to work for you, and use the money in the dedicated savings account just to cover unexpected emergencies. Now, the amount that you choose to put in that savings account is going to be entirely up to you. And the reason is because we all have different needs. We all have different expenses. We all have different responsibilities. Some of us are single. Some of us are married. Some of us are married with children. Some of us are single with children. So the type of unexpected expenses that we could have varies greatly. Some of us have mortgages. Some of us rent. So if I, for example, have a mortgage, and let's say my mortgage is $2,000 a month, and someone else pays rent, and their rent is $1,300 a month, I need to come up with more money to be able to pay my mortgage than someone else who rents. And the amount of money that you choose to have in that savings account, once again, it's entirely up to you. Generally, it's recommended that you have 3 to 6 months of monthly expenses to cover unexpected expenses. For example, let's say your total fixed cost per month is $2,000. So 3 months worth of expenses would be $6,000. So if you wanted to have an emergency fund with 3 months worth of expenses, you would need to have a dedicated account that is solely for emergencies and have $6,000 in that account. Now, while some people will be more comfortable having more money saved up, some others will be just as comfortable but having less money saved in that account. The main thing is that you have that account, and it has to be strictly for emergencies, and you should not touch it unless you have an emergency. That will allow you to not freak out, not make emotional decisions, not sell shares of your investment at a loss in case there were any drop in the market and your investment ended up being temporarily affected, but on paper, because you do not realize any losses in the market until you've actually sold your investments. So if you do not have an emergency fund, however small or large it may be, then you are not in the ideal position to invest in the stock market. Now, if it's going to take you a long time to be able to save up to create that emergency fund, whether it's going to take months or even a year, then that should be prioritized, because I just don't want you to be in a situation where you're investing money in the stock market, you do not have an emergency fund, and some kind of emergency occurs and you have to sell your investment at a loss just to be able to come up with enough money to cover that emergency. Emergencies are exactly that. They are unexpected in nature. Now we're going to go over an example just to demonstrate the importance of having an emergency fund. Let's say, for example, you have $3,000 to invest, right? And you invest that entire sum. And now let's say you want to buy an index fund. Let's say the index fund costs you $100 per share. So $3,000 divided by $100 per share, you would have 30 shares of that particular index fund. Now, let's say you have an unexpected emergency. You do not have a dedicated emergency fund. You do not have a dedicated account with some money in it to cover emergencies. If you get into a car accident and your deductible is $500, you don't have an emergency fund where you can get it from, and the only money that you have is invested in the market in that particular index fund, you're most likely going to have to sell part of your investing so that you can cover that $500 expense. Now, because the stock market is unpredictable, over time we know that you can make money using the stock market, but over the short term, from day to day, week to week, month to month, the stock market can be very volatile. It can go up and down, up and down. So that applies to your investments as well. You could have bought that index fund at $100 per share. You got 30 shares using $3,000. But let's say there's an unexpected crash in the stock market, and that can happen for a multitude of reasons. We can discuss that in future videos. And now let's say on the date that you need that money, you know you're gonna need to come up with $500 to cover your deductible. So you log into your account and you decide to sell just enough shares so that you can come up with the $500. But as a result of the sudden crash, the price of that particular index fund goes from $100 that you paid for it to $80. So now if you sell it, you can only get $80 for it per share. So now to get the $500, you would have to sell approximately 7 shares, which is 7 times 80. Now, because you may not be able to sell a fraction of a share, you would likely have to sell 7 shares for $560, which is 7 shares times $80 per share, so that you can come up with $560, which would be just enough to cover your emergency. Now, what has just happened is that you've just literally lost $20 per share, which is $140, right? You sold 7 shares at $20 less than what you purchased that index fund for. That's $140. So you've lost $140. Yes, you are able to cover your emergency, but you've lost that money and it's a permanent loss. Why? Because now if you come back to the stock market, let's say 2 months or 3 months later, and you want to buy that same index fund, because of the volatility in the market, 2 to 3 months from now, the price of that index fund may no longer be $80. It might be $110. So to buy the original 7 shares that you no longer have, you would need not the $580 that you originally got, you would need $770 to buy those shares. And what basically happens in this case is you sold at a loss and then you're buying when it's higher, which is exactly what you're not supposed to do when you're investing in the stock market. You're supposed to buy low and sell high, not the opposite. In your example, you sold low and you bought high. Now, if you had had that emergency fund, you wouldn't have had to sell your investments. Your investments that you originally paid $3,000 for, $3,000 gave you 30 shares. Those same 30 shares, because they were not sold, you had an emergency fund, are currently worth $3,300. So originally you invested $3,000, now it's worth $3,300. So technically on paper, because you have not sold those shares, you've gained $300. Hopefully in that example, I was able to demonstrate and you understand why it's important to have an emergency fund so that you don't have to sell your investments just to cover an unexpected expense. And if there's one thing that you learn when it comes to investing in the stock market, is that you should give your money the time to work for you. Do not interrupt the process. So if you're investing, I would strongly suggest that you invest for the long term, meaning 5+ years, 5 years, 10 years, money that you do not need in the short term. Why? Because that allows you to invest and that allows your money to compound over time. In the future video, we will discuss compounding further, but simply put, here is an example. If I have $1,000 invested in the stock market And let's say within a year, the rate of return was 10%. So over that 1 year period, I go from having $1,000, now my $1,000 is worth $1,100, which represents 10% of $1,000. Now, if the second year that I'm investing, the stock market also goes up by another 10%. Now, that extra 10% would not be 10% of $100, it would be 10% of $110, which is a return on investment of $110, not $100 like the first year. And if you look at this over years, now at the end of the second year, you don't just have the $1,000 that you invested. You have the $1,000 that you invested plus the $100 that you earned after year one, plus the $110 that you earned after year two. That gives you a total of $1,210. Now, of course, over certain years, the market will go down, so it's going to be a negative rate of return. In some other years, it's going to go up. But over time, it's been proven since the existence of the stock market that over time, you end up coming out ahead. And that is if you invest and you invest consistently and you do not interrupt the process. You just allow the money the time that it needs to work and compound for you. So hopefully with that example that I just went over, you can see how time comes into play. So when it comes to investing in the stock market, time is your best friend. The longer you have to invest, the more money you can make, and the more your money can make money over time. Now, hopefully you understand why it's important that you have an emergency fund before you start investing. Try not to be like the average American who cannot come up with $1,000 in case they have an unexpected emergency. You may have gotten a raise from work, but the raise that you got is not enough, right? It's not keeping up with the pace of inflation. So I understand how it can be tough, but I'm not expecting you to come up with an emergency fund quickly. It's something that it may take you a few months, 6 months, or even a year to build up. If you have to work extra, if you have to work overtime, maybe that's what you have to do. If you can have any side hustles to get some additional money, maybe that's what you have to do so that you can build up that emergency fund. Once you have that emergency fund set up, then you will be able to start investing and give your investments the opportunity to remain invested and to grow uninterrupted. So the emergency fund is our term for today, and next week we will come up with different terms, but I just want you to stay tuned. So to recap, I'm going to leave you with the first 3 points that we went over. Before you invest or before you start investing in the stock market, make sure that you understand what you're investing in. That's number one. Number two, if you are investing in the stock market, do not invest money that you cannot afford to lose. Basically, don't put your entire life saving in all at once. And remember, number three, we all make mistakes, but I just don't want you to be in a position where you end up losing your invested money, because that would completely defeat the purpose of investing, which is for you to take $100 and turn it into $110, to take $1,000 and turn it into $1,500. That is the point. If there are any terms that I mentioned in this video that you do not fully understand, it's likely that I've already covered it in prior videos. So I would strongly recommend that you go to the prior videos. I'll see you next time. Have a good one.